Good morning or afternoon, everyone. Welcome to our very first Q&A Cafe for Business by Design of 2021. Today's January 13th. We are doing revenue recognition with Alex Waddell. He will be our speaker today. Just a reminder to everyone, I have everyone on mute for the duration of the session, just so then the recording goes well and we don't hear any background noises. So we are recording this session. It will be on our YouTube channel after this, and it will also go out in the email through the GoToWebinar tool. With that email, you'll get some more information on how to register for our next Wednesday session, which is create pricing procedures using custom fields in SAP Business by Design. So if you are interested in that, or you have a coworker that's interested in that, get them to register either through the email that comes out, or you can get the link through our website. It's on the resources page. Scroll all the way to the bottom of the page and you'll find those registration links. So if you have any questions, please put them in the questions or the chat box and we'll get to them throughout. I'll help Alex watch out for those. But without further ado, I'll hand it over to you, Alex, and mute myself.
Great, thank you, Kayla. Happy New Year, everyone. So welcome to this session, SAP ByDesign Revenue Recognition. Today, we will probably just sort of scratch the surface of revenue recognition. My objective is to kind of give you a high-level overview of what it can and maybe some of the things it can't do for you, some of the mechanics of it. If you've attended my sessions before, you probably know that I like to work a lot inside the product, and it's more like a demo. This one might be a little bit of an exception. I will go show you a few things in SAP ByDesign, but this is going to be a little bit on the PowerPoint side because it's probably a little bit easier for me to explain some of the concepts around revenue recognition through visual graphics. And it's kind of difficult to configure a demo environment to manage all the different types of options for revenue recognition. So with that, we'll dive in. If you do, like Kayla said, if you have any questions, also maybe right now, if you wanted to just drop into the chat window or the questions, if you are currently using revenue recognition and you're trying to expand your knowledge, or if you are completely new to it, feel free to drop that into the chat or the question panel. I'd be curious to know kind of who's out there. So let's talk a little bit about the benefits to revenue recognition. So what it really does, it allows for automation and the following of various programmed accrual methods to defer both costs and revenue when using various types of projects, sales orders, or customer contracts in the system. So very useful, very much an accounting world thing, very useful to when you have things happening in the real world in different calendar periods or different fiscal periods, but you need to line up the revenue and the costs in the same period. And typically in the old way of doing that was maybe a very manual method to kind of back out revenue and defer things and then, do journal entries. These features in the system will allow you to do, add some automation to that. So some of the elements around revenue recognition. First of all, you need to configure it to automate the assignment of the accrual methods. And this is sort of in order. Obviously, once you've configured it, you don't have to configure it again. And then from a process perspective, you'll generate customer-facing revenue recognized objects. So as I've mentioned, there's a certain number of objects that are eligible for revenue recognition. So sales orders is one, certain types of projects, customer contracts, things like that. You have the ability to validate and modify the accrual methods, which could influence the timing of the recognition of the revenue. Then you would enter relevant transactions that will potentially be deferred. So that can be things like timesheets, customer billings, customer deliveries, things like that. You would have the option of monitoring specific revenue recognition proposals. There's a screen I'll show you where you can do that and update it, if you need to on sort of a one object by object basis. And then you would run the monthly revenue recognition job, which is going to go through and based on everything that you've done in the previous steps is going to now, sort of automate the process of doing all the journal entries to start accruing or reversing the accruals depending on the timing of your objects. And then lastly, you'd want to just verify the results of that revenue recognition job. So a few things that are good to know. Talk a little bit about configuration of revenue recognition. Um, if you're familiar with project scoping, you would have to go into the project scope and you would have to turn it on. So there's some checkboxes I've highlighted there, which is essentially saying you want to use revenue recognition. It's important to note that there are some features in the system that cannot be deactivated once they're turned on. So you definitely are gonna, we'll talk about that a lot more later, but you're gonna definitely wanna do thorough testing before you do this in your production environment. It is a complex engine in the system, and you may not be able to back out of it or change your mind afterwards. So you have to make sure you test it in a test environment. You're very satisfied with how it's working before you implement it in your production environment. So I do wish some of these settings had maybe like a little skull and crossbones beside them, but just a good thing to know. So once you've activated in the fine tuning activities, there's really just one screen that you go into to set up your accrual determination methods. So you'll see here that in this grid, I've set up 10 or 11 different types of accrual methods, and then at intersections of different companies, sets of books, products, even in product categories, well, that's optional. You can then determine what the revenue type is and what the accrual method would be. So the revenue type is really those objects I was talking about in the earlier slide. So is your revenue recognition going to be based around a customer contract, or is it going to be, based around, let's say, the sale of a product or even a customer project? And then you can have multiple revenue types in play, like we do have in this demo environment. And the system will then do a default accrual method based on how you've configured it in the screen. And those accrual methods are also variable depending on the revenue type. So not all of them are available to every type. In this screenshot I'm showing you here, this is really the contract one. So for a contract, you can set a deferral method, which is continue to defer, recognize based on manual amounts, uh, a reversal one, which just causes it to not to just reverse out, and then various options around how you want to do it just on straight line methods. So we'll talk a little bit about these when we get into them, but just at a very high level, like I would say typically on a contract, you would probably use one of the bottom three, probably straight line even periods is a nice simple way to do it. So I will actually be showing you a sample of that in the system. So where we maybe have a contract, you have a contract with your customer, and perhaps you bill them every quarter or every year, but you need to recognize the revenue every fiscal period. So even though your contract extends over 3 or 6 or 12 months, you're going to defer the revenue when you do the billing up front, and then you're going to draw down on that deferral each month based on these methods here. And so when you get into the little bit more obscure ones like continue to defer and manual amounts and stuff, that's probably not something you would do as a default accrual method. That's probably something you would override on a specific project or a specific scenario where maybe there's something happening with that specific contract where you need to defer the revenue or continue to defer the revenue until such point that you want to just start recognizing it. And then it could be based on the manual amount. So you might actually move through those different phases, but that would probably be more likely happening on the specific contract or the object. So once again, what you're seeing here is really just the default method that's going to get assigned behind the scenes when that object is created in the system. And then one last step, so this is just the account determination screen. If you are working in finance and account determinations, you're very familiar with this. So under the sales tab, you would go in and there's a revenue recognition deferrals and accruals tab. And this is where you would put in, your deferred costs, your accrued costs, your deferred revenue accounts. So you would have to make sure that all of those GL determinations and those accounts also exist in your system prior to any of these elements working for you. So once you've done those steps, you really are in a position to actually just start using it. But as I mentioned before, the complexity is really around the process and all the different scenarios. So I'm going to just run us through a few common scenarios. And this is by no means all of them, because there are so many different ways that you can configure a by design process, like a single process, like even a sales process. There's multiple different types of projects and different ways that you can manage contracts and link them to other objects. So all of those things potentially will impact revenue recognition. So really, it's just a matter of testing, getting your scenario set up to the way you think it's going to work and test it, and then validating all those entries. So I'm just going to run you through a couple, maybe simple towards the most complex, just to give you an idea of scenarios that we often see. So here's a common scenario, which is product sales. So delivery versus invoicing happening in different periods. So very common that you may deliver a product, you may deliver it on the last day of the month. So it leaves your inventory. In the traditional world, that would trigger an entry to recognize your cost, but potentially you don't actually bill for that item that's left your inventory until a few days later. So now it's a new month, maybe it's February when the billing goes out. So in the old world, you would now recognize revenue in February. And this causes you, of course, a misstatement in your financials because you have costs and revenues in two different periods. So the way revenue recognition would work here is the product, when you do that delivery, so that's the first square, it's delivered to the customer, it would actually hit a deferred cost of goods account and it would relieve inventory. And then still happening in January, you would run the revenue recognition process, and the revenue recognition process would go through all of those sales orders, and based on the accrual method, so if the accrual method in this case was set to recognize on delivery, the system would say, okay, here's an object where the delivery has happened, but the invoice has not happened. So now it's actually going to reverse the deferred costs. It's going to recognize the revenue, and it's also going to recognize the cost of goods. So it's going to really just sort of establish everything in the month. And then in February, when you get that invoice out the door, that invoice is going to hit an accrued cost of goods account, and it's going to, so it's essentially an accrual there on the revenue side as well. And then there's going to be another revenue recognition at the end of February, which is going to see this transaction as fully closed out. And so then if there's anything left to close out off your balance sheet, it's going to reverse those accruals as well, which should offset, that February invoicing transaction. So a lot of accounting entries are happening here. So you definitely need some accounting expertise when you're analyzing this to understand. And all of this is sort of invisible maybe to the people using the system that are actually doing your deliveries and doing the billing, unless they are drilling down and examining the journal entries. This is all sort of invisible to them. So another scenario, very different than the other one, is the contract scenario. I described that briefly earlier. So you may have a quarterly or annual contract to your customer. So perhaps you bill them for a service or a license or something like that, and you bill them once a year, but it really represents a year's worth of services or a year's worth of licenses or something abstract like that. So in that situation, in January, we've signed the contract, we're going to bill the customer, and you're going to debit AR, but you're going to credit a deferred revenue account. And then January month end, you're going to run the revenue recognition, that's box number 2. And then based on the accrual method, it's going to determine, okay, how do we divide this revenue? So you saw one of those previous slides, there was an option to, let's say, divide the revenue equally over all the periods. So it take that total contract, divide it by the dates of the contract, and now it's going to just do that portion for that month, and it's going to debit the revenue, credit the revenue. It's going to debit your deferral, and it's going to start drawing down on that deferral that was set up by your billing in the first place. And then February comes along, and maybe there's no customer transactions. And then we run revenue recognition, and revenue recognition is going to work exactly the same in February as it did in January. If that contract is still in play, it's going to keep drawing down on that revenue deferral, and it's going to credit your revenue. So project revenue recognition based on percentage complete. There's quite a few different ways to manage revenue recognition between project accounting. Project accounting is very complex in SAP ByDesign, so I would definitely say these scenarios start to get into a lot of challenges, a lot of complexity, but here's one that's fairly straightforward. So if you're saying we have a project that we are doing for our customer, maybe we're actually billing them as time and materials are consumed on the project, but we want to recognize the revenue based on the percentage completion of the project. Therefore, maybe the project is expected to go 6 months, and you're billing each month, but for some reason during 1 month you don't have a lot of work on that project, so the percentage complete doesn't really move. You might want to continue to defer revenue or costs in that scenario. So this situation, we have time billed to a project and to a customer, let's say in January. Everything just goes into the deferred costs, like all the timesheets, all the billing goes into deferred revenue. Then there's a step that's a little bit different from those other scenarios where the project manager is probably going into the project and doing some updates. And there's a few different ways you can even do the percentage complete. So you could have the system determine the percentage complete based on budgets and actuals that you've set up in the project. You may decide that that's an accurate way to do it. Or you may want the manager or maybe somebody in accounting to manually override the percentage complete on that project. So once they've done that update, then the January revenue recognition would run, and it would relieve the deferred costs, and it would relieve the deferred revenue, and it would book everything based on that percentage completion based on either option 1 or 2. So let's just go into SAP for a moment, talk a little bit about some of those documents. I'm just going to walk through one as an example. So let's go into, let's say, a contract in the system. And I've set up a contract in advance here. So this is where, your salesperson or the person actually, working frontline facing the customers, maybe setting up the contract in the system. And once again, revenue recognition is going to be determined typically on those accrual methods that were set up behind the scenes. So it's not even obvious to them that any of that is going on. They just set up the contract the way they normally would. So there's nothing in here that's really pertinent to you as an accountant for revenue recognition, except that the contract has a start date and an end date. And that contract start date and end date, if you are doing any period-based or time-based revenue recognition, that's the period it's going to use. So you can see that this is a 12-month contract extending between August of last year to August of 2021. And so the expectation is we may be billing this contract, well, it doesn't really matter when we bill the contract, but it's going to recognize the revenue based on the combination of this start and end date and that accrual method that was put into play. So that's all you really care about from the contract perspective, as maybe the person doing the testing of the revenue recognition. Maybe we will also just point out that this contract has a number of different items on it. So there are 5 rows, and you do have the ability to treat different rows with different revenue recognition methods. I wouldn't say that's very common, but that's available to you. So let's say you are now the person who's responsible for revenue accounting in your organization. And you want to analyze what's going on with this contract. The contract, the sales order, the project, or whatever has been set up, but you're going to really work down here in the cost and revenue work center. And you're going to go into either the projects or the sales documents, depending on which revenue recognition we're talking about. And both contracts and product sales work out of the same one. You'll see there's a sub-menu heading where you can fluctuate this between returns or services or contracts. So I'm going to go into contracts and I'm going to search for the contract I just showed you. And this screen is different than the one we were just in, which was the contract setup. This one is really kind of telling us what is going on around revenue accounting for this contract. So there's our 5 rows. And we have some sub-tabs at the bottom here. We know the general tab, that's fine. That's telling us what the services are about. The accounting data is telling us which set of books and which revenue recognition is really in play. So if I go, for example, to my dates, you can get you don't have to go to the contract like I showed you before. You can just go right here and you can see, okay, this contract is set up between the 25th of August 2020 to the 24th of 2021. So based on that, and the revenue recognition method is going to determine my, and this is a test environment, so there's all sorts of weird accrual methods set up, but let's just look at one that's very standard. So if we go look at the software row, we can see that someone has chosen straight line, prorate, partial periods. So once again, that's automatically assigned by the system based on the way you've configured the default to be. I, however, could go in as a revenue recognition accountant and I could manually override that for a specific contract into, a different method. If I'm satisfied with these, what I'm seeing is also the ability to have different methods based on different sets of books. So I could, in theory, have revenue recognition behaving differently for my IFRS accounting versus my US GAAP accounting. So that is available to you should you need it. And but in this case, they're both the same. And so what you can see here is this is straight line, prorate, partial periods. So the way it's sort of come up, if you were to take 6,000 and divide it by 12, that should be about $500 a month for software. But because we're saying prorate partial periods, the system has actually taken those, whatever it was, 5 or 6 days in August and figured out the exact prorated amount that we should book in August. And it's doing the same thing for the 24, 25 days that we have in August of 21. And it's figuring out what that proration would be. And then it's taking the net amount of that and dividing it by the remaining 10 periods. And so that's how it's come up with this 499.13. So at the heart of it, this is what your revenue accountants are really interested in seeing, because this is kind of giving them a forecast of how that contract's going to work from a revenue recognition perspective. So, and we can see here that the realized revenue tells us that August and September have actually been booked, and that's through a job we're going to run in the system. But October has not yet, October or anything beyond that has not yet been recorded. So I've given a lot of information there. I'm just going to pause for a breath. If anybody has any questions, feel free to drop them in the panels. Now, if you want to talk about the jobs, well, let's look at some of the journal entries that are happening. So I'm going to go back to our contract for a moment, just to reinforce what I showed you in PowerPoint. So let's go have a look at our document flow for this particular contract. So we can see here that there was an invoice that occurred on November. There's actually a number of invoices. I'm just going to go look at that journal entry, because all I wanted to illustrate to you is that regardless of your billing schedule, so this particular contract, I mean, I think it was worth, I mean, overall the contract, probably a better way to see the total dollars, but you can see here that the value of the contract is fairly significant, right? Over $10,000. But you can set up your invoicing schedule however you like. So that happens regardless of what's happening in your revenue recognition. So in this case, there's been a number of invoices. It could just be that you have a single invoice at the beginning of the year. But regardless, the system is going to, based on those accrual methods, it's going to say, well, I'm not going to book any revenue, despite the fact that this is an invoice. So instead of crediting revenue, it's going to credit deferred revenue for whatever the value of the invoice is. And then it's obviously going to set up your accounts receivable asset. So that's the invoicing event. Disconnected timing wise from the revenue recognition, that works very slick. Now, if we were to go back into our cost and revenue work center, we can run revenue recognition for a specific item from that screen we were just in, but I'm going to show you a different way, which is the way you would run it as a periodic task. So each month you would go in at the end of the month, once you've sort of analyzed all of your revenue recognition eligible sales orders, projects, et cetera, and you're satisfied with them, that they're set up properly, you would run this job, and then this job would just really cover all of the documents. And I think I ran this one earlier, so maybe I can just cheat and see if I can find it. And that's not cooperating for me, so that's fine. I'm just going to run it from the beginning. So I'm just going to run revenue recognition for contract 223. And once again, this is totally up to you. You can run it for an individual item, which is very useful if you've got a complicated sort of revenue recognition object and you want to see what's going to happen just with that item, which is what I want to show you here. But more commonly, you would just run this wide open because you've validated everything and you just want to run your entire revenue recognition. Now, when you do run it, you can run it the initial time in the test mode, meaning it will tell you the journal entries that it's going to book, but it won't actually book them. So that's very useful. So this particular contract is tied to company 1000. I don't need to enter a set of books, so I'm going to leave that alone. And you saw in that screen that period 10 had not been done, so that's the period I'm going to run. And then because I'm targeting a specific document, I'm going to go down here and specify, okay, I'm looking for a specific contract on 223. And it doesn't, these are the different rows in contract 223. It doesn't really matter which one you select. It's going to choose the whole document. And then I'm going to start that. So this will take a moment to run, but it shouldn't take long because it's only a single document. So already finished. We can go into the display log. There won't be any journal entries because it was test. And you can see that this system is configured with multiple sets of books. So you could have had a different revenue recognition method. They happen to be the same, but I'm going to go into US GAAP and I'm going to view this. And we can kind of go see the net postings. So I'm not going to break down all the math for you, but here's where we've got our credit to sales. We've got, an unbilled receivables, happening here. So there's quite a few different things happening in here, but what I'm really going to focus on is really deferred revenues and that. Looking at it from the journal entry perspective is a bit confusing because this is sort of consolidating all the rows. So you're probably better going to the proposed successfully and you get a little report. So all of your revenue recognitions kind of fall under these categories. They're either event-based, they're percentage complete-based, they're time-based, or they're time and material-based. So contracts are going to be time-based. I'm going to go here, I'm going to execute this. And now we can see something that's a bit more legible. So we were looking at row 40, where that $6,000 annual contract means that this month we're going to recognize $499.13, which exactly ties into what was showing on that revenue recognition sales object. So hopefully I haven't lost anybody with this. This is a very straightforward process. If you're interested in seeing other processes like revenue recognition for contracts and things like that, those take quite a bit more work to kind of configure, to demo and set up. But we could assist you with that if you want to understand them. But like I said, the purpose of this session was really to kind of introduce you to the capabilities of the system and get an idea of what it can do for you. So with that, I'm just going to go back to the PowerPoint slide for a moment here. Bear with me while I transition back into PowerPoint. So some things to consider, and these are just really lessons learned from years of us setting this up for our customers. Configuration of the system, it's not time consuming. I showed you really all that's involved in setting it up, so you can probably go in 15 minutes and kind of activate the features. But really understanding the implications of the revenue types and the accrual methods is complex. So you very likely it'll take some learnings to figure out what those different accrual methods mean in conjunction with the different types of revenue recognition objects in the system, meaning projects, contracts, etc. Also, multiple revenue recognition types could lead to unpredictable results. So for example, if you have a scenario where you want customer projects associated to your customer contracts, now you have a challenge because revenue recognition will behave differently on contracts than it will on customer contracts. So we have run into scenarios where we have to make a decision, which one is the priority? Because if we want project accounting wrapped around contracts, that potentially is going to break the way that, contract revenue recognition it works for them. So just understanding like all of those scenarios, it can get to be pretty heady when you start to examine all the options. Activating revenue recognition may lead to deferred entries with subsequent auto corrections, even when not desired. This can create confusion in document flow and troubleshooting issues. So that is a significant concern. So if you are using, let's say, project revenue recognition, project accounting in the system, once you activate it and you start assigning accrual methods to it, possibly the system is going to just run everything through revenue recognition, even when you don't really need it to. So let's say you are doing sort of time and material-based billing, and you want to recognize the costs each month as they occur, regardless of percentage complete or some sort of deferral event. What you will find is every time you do a time entry in the system's fine with that. It's fine with you doing that and setting the accrual method to recognize it as it's done. But what it still does is it hits your deferred revenue account when you, let's say, book a timesheet instead of your internal cost allocation. And then the system will do a journal entry immediately afterwards to kind of correct that event. And that's outside of you running the revenue recognition job. It just seems to, like, I don't know why they developed the system that way, but they just decided it was easier that they all go through the deferred costs, the deferred revenues, and then the system does these correcting entries. Well, what I don't like about those correcting entries is they don't show up in the document flows. So if everything's working fine, it's not a big deal. But if you are trying to troubleshoot some sort of an issue, you believe that a project's wrong, it can take quite a bit of digging to try and figure out, okay, where are these journal entries? How do they relate to each other? And what's the exact flow of all the entries? And so that definitely poses a lot of learning curves when we're both learning the system, but also when we're troubleshooting issues. The next one is, despite complexity, not all revenue recognition scenarios have a solution. So it seems like there's a lot of options there, but revenue recognition is really complicated. It's very variable to your business, what it is you're trying to accomplish, what processes you're trying to use. So it is possible that you're going to set this up and it's not going to work exactly the way that you want. I hope that's not the case for you. Or it could be a case where maybe it just works only partially the way you need it to. So I gave you an example here. So one thing in the system is you are unable to defer costs associated with a customer project where you're successfully deferring revenue. Sorry, I meant to say customer contract there, not customer project. So what I mean by that is, let's go back to that scenario where we had that contract that we were deferring. We want to invoice the customer once a year and we want to defer the revenue over the 12 months like we did from August to August. Well, let's say the actual cost of that contract is not internal. Maybe you have to outsource it to a third party. So you end up paying a supplier for that same annual contract, probably at a lower rate because you've got a profit margin built into it. And one would think that, okay, can I just link my supplier invoice for that annual cost to the contract and also defer the cost and amortize those costs over the 12 periods? We have not been able to find a way to get that to work. So it's just like I said before, there's so many different business flows and business scenarios. You may run into one where you just cannot find that right combination to work. So in that example I just gave you, it wasn't a huge deal. We are taking advantage of revenue recognition from the revenue perspective, but from a cost perspective, we're manually booking the cost into, a prepaid expense account and using a very traditional accounting method of, doing recurring journal entries to amortize our costs over the year. So you might see that as a shortfall, but once again, it's just the inability of the system to sort of handle every different multitude of business scenarios, which really ties into this last one, which is due to the variations in ByDesign processes combined with revenue recognition features and also, all the different processes that our clients bring to us. Testing is really extremely critical. So, and once you start adding complexity to it, like intercompany billing, so you've got multiple companies that are doing business with each other with revenue recognition, or you have multiple revenue types, the list goes on. So once you start adding all of those complexities, it's going to be really critical. I mean, it's really critical to test in any scenario, but I would leave yourself a lot of time to test revenue recognition, especially so that you aren't frustrated when you activate it and you have unpredictable results even 2 or 3 months after you've gone live with it. So that brings me to the end of our presentation on revenue recognition. Thank you for joining us today. I'm happy to answer any questions. I haven't seen any show up in the slides yet, but if there's anything else that we can help you with, feel free to reach out to us. And with that, I'll hand it back to Kayla.
Great, thanks, Alex. And we will see you next week for our Q&A Cafe on create pricing procedures using custom fields in SAP Business by Design. We'll see you then, same place, same time. Have a great rest of your day.